and thanks for joining us this afternoon. My name's Tas Demos. I'm a partner at BDH. And to my right, I have Sharon. Sharon, I've known for too long. Sharon's background, I'll let her explain it, but I met Sharon over 20 years ago while she was working at Macquarie Bank, and just recently, in the last few years, has set up her own business dealing with clients and managing their financial affairs insofar as loans are concerned. She has a great deal of experience both dealing with residential customers and clients and matters, as well as commercial and business matters, which is basically predominantly the transactions that Sharon and I do and our clients do with Sharon. Her level of service, nothing is too difficult for Sharon, and if there is a deal to be done, she will find it. And while she will generally go to the major banks, being the NABs and the CommBanks and the ANZs, she will also look at other type of funders that may be able to put the deal together and get something across the line to facilitate what our clients want to do. So without wasting any more time, I'll hand over to Sharon. What I will say is if people have got questions, because we're having technical difficulties, can you please just drop a question in the chat box, and we'll come to it either during the presentation or after the presentation. Thank you. I'll hand you over to Sharon.
Thank you, Tas. Hi, everyone. Thanks for the intro, Tas. So just briefly, as Tas said, I've spent over 20 years in Macquarie business banking prior to starting up my own finance broking firm about 5 years ago. I've been working closely with Tas's clients, a lot of them, and today I just want to give you a bit of an overview of where we're at in the economy and some funding options available rather than just your everyday sort of stuff. We'll touch on that as well, but I'll just mention some other things that might be available that might be helpful to you personally or to your business as well. Okay, so next slide. So I just put a few points together about sort of where we are now, which most of you will know all of this, so we'll just have a quick chat through that. So obviously we're in the middle of a pandemic, which is a once in 100-year thing, something we'll only see once in our lifetime, thank goodness. Whilst we've been going through this the last couple of years, governments all over the world have been printing lots of cash to sustain economies, which now has resulted in a lot of cash floating around in the system. And as you would have been hearing in the news, this is now leading to huge inflationary pressures in all Western economies. As a result of this, rates are now starting to rise to try and control inflation. And this is now having flow-on effects in households. There are supply chain issues leading to increased cost of goods. So you'll see this everywhere, supermarkets, if you're renovating your house, if you're buying a car, all that sort of thing. People are, while people have cash in the bank, they're also fairly geared up because we've been in such a low interest rate environment and people were taking advantage of that cheap debt. And also because we were fairly ill-advised from the RBA that rates wouldn't move until sort of mid-2024. So people thought they had this great cheap debt for another couple of years yet, and all of a sudden we've been hit with these very fast, significant rate rises. So today we're sitting at a cash rate of 1.85. So we've had 4 rises, we've had 0.25% and then 3 0.5% rises every month since the rises started. And that's sort of where it's sitting at the moment. Next slide, please. So where we're heading, look, depending on where you take your information from, there's a few different views out there, but the general consensus is that the cash rate will land around the 3% mark. You've got economists at the CBA saying it won't get that far, it'll be 2.6, 2.7. You've got people at ANZ and Westpac saying, no, it's going to go to 3.25. So depending on where that lands will obviously influence what your home loan rate will be and what rates you're paying on your business debt. But the general consensus is the standard variable rate will land somewhere around the high 4s. That's for your owner-occupied home loans with principal and interest repayments. Obviously, we're still in a fairly low rate environment compared to history, but in saying that, still a bit of a shock for people after having such cheap money for a long time. So,
can I just butt in there?
Sure.
Whilst we are in a cheap interest rate environment, I suppose the asset cost on the flip side is significantly higher than what it was
correct
in the last 20 years.
Mm-hmm.
So the impact of maybe a 4% interest rate might be the equivalent of something like a 12 or 13% interest rate historically.
Very true. Very true. Having to raise a lot more debt. No, anytime. So yeah, look, I think there's also a lot of talk. Is the RBA rate rising too fast? Because they're trying to get this inflation under control, but these rises take a little bit of time to have impact. So if you're a betting person, you probably say they are rising too fast, and they'll get to a point and they're going to have to start bringing rates down again to compensate for what's gone on.
And that's going to look, I suppose, and there's probably going to be a 6-month lag time between the interest rates going up and the impact on the economy and the data they're seeing. So
correct.
They might have to come back a bit.
That's right. We'll go on to property prices on the next slide, please. Okay, so just as far as the residential market and funding update in relation to assets in that space, again, not telling you anything you wouldn't already know, the market has slowed. Prices are down anywhere between 5 and 15%, depending on what area you're looking at. But I get further to what Taz was saying, we have to remember that prices have risen 35% over the last cycle. So if you look at what your property was worth 5 years ago, as opposed to now, you're still well ahead.
Even pre-COVID.
Yeah.
You're talking 2019.
Yeah, so that's right. So cycle, we're talking sort of 7 years. So look, yes, prices have come back a bit, but huge rises before that. And history shows that once again, they will bounce back.
Look, in talking to some real estate agents just recently, what they're saying to me is they're plateauing out, so they're not seeing many more dips. They're sort of stabilised now, and I think people have got the fact that there's potentially some more interest rate rises in the back of their minds, determining how much they're going to be paying for property. They're not going as stupid as what they previously were, and paying over what property was truly worth to buy it. So
yeah, which we saw a lot of over the last couple of years. So just sort of leading into the next point, it can be a good time to expand your portfolio. There are some opportunities out there because of this settling down of prices. So there's people out there looking at this time as a good time to seize opportunities. At the moment, from reputable lenders that I like to use, you're getting a home loan rate from about 3.74% after the last rate rise. Look, there are some flashy rates out there and your online digital lenders and all that sort of stuff. But if there's any sort of complexity to your situation at all, I would not recommend using those sorts of lenders. You need a bank that's going to be able to understand the information and your situation and work with that. So 3.74 is a rate that I'm talking for your standard lenders, not just your majors.
And that's a variable rate?
That's a variable rate. Difficult time to take a fixed rate at the moment. We'll talk about those in a minute. But look, it's definitely worth reviewing your finances. I think the last couple of years, because we've had such cheap money, people have tend to sort of let things be. Some have been very proactive in going out and getting those lovely cheap fixed rates we were getting before Christmas of 1.89% for a couple of years. But if you have left your debt sitting as it is for a while, it's a good time to look, because if you've been with a bank for a long time, they generally won't reduce your rates unless you ring up and ask for it. So that's your first point of call, and then you can see what else is out there. If you're thinking at the moment, gosh, I need some certainty, I don't know where these rates are going to go, and you want to look at fixed rates, there on the screen is what you can get. That's just one of my lenders I've chosen as an average sort of benchmark. Now, those rates were higher a month ago. They've actually come back, the fixed rates. So they're moving around all the time, depending on what data's out there and what economists think is going to happen longer term. But you can see it's fairly expensive to lock in at the moment.
From what I've heard, though, too, Sharon, they're talking about bringing those back, the fixed rates, even further.
Yeah.
Even if there is another interest rate hike in the next, 2 or 3 weeks?
Yeah, that's right, because they're always building and looking at longer term. But see, last month, your 5-year rate had a 6 in front of it, and it was more like a 6.5. So, when we look at fixed rates again next month, they will probably be slightly lower again. Okay. All right, next slide. So commercial funding, just touching on commercial property here. So compared to a few years ago, there's quite a few more options with commercial property and more favourable terms. So quite a number of lenders now offering 30-year loan terms on commercial, which was not sort of...
what was it, about 10 to 15 years, wasn't it?
It was 15. Some were doing 20 for a long time, but 30 years is more of a recent thing, which is great for cash flow. They're also loans that you can, like a home loan, put in place and you can sort of set and forget. There's no annual review of financials or any metrics that you have to meet from a business point of view. And the other great thing that's happened with commercial property is you can now go up to 80%. You can borrow up to 80% of the value of the property, whereas previously you were looking at around 65.
Is that with the major banks, the 80% LVR?
Some of the majors, yes. So ANZ have a very good streamlined commercial property facility to go up to 80%. If you're looking for a second tier option, there's sort of Liberty that will go to 80%. Pepper will do 75%. So just depending on your financials and where things are at with your business at the time, you can see you've got a few different options there. But for commercial property, I think it's good to be able to set that over a 30-year term and not impact your cash flow as heavily as it probably were before.
Can I ask a question in relation to commercial property funding? Because most people would turn around and say, hey, I bank with the ANZ for my home loans. Let's talk to the ANZ about commercial property funding as well. My view on this stuff, and I'd like to know what your view is. My view on this sort of stuff is that I don't necessarily believe that you should be going back to your home loan provider and getting funding for your commercial property. I think you need to look at other options. What sort of, like maybe look at the National Australia Bank or whoever will give you an 80% LVR, so you're kicking in less.
Yeah.
What's your view on that?
So my view is, as opposed to 10 or 15 years ago, there's no real value in being loyal to a bank anymore. There used to be. You used to have much more relationship style banking, and while some of them still call themselves relationship style bankers, now it's quite different to how it was. So I would definitely recommend looking at all of your options when it comes to funding and not sticking to a particular bank because your home loan's there. I think you've got to move with the times. As policies are changing all the time with lenders, and this is why I'll get myself some business here. It's good to have a broker because we have to be across these policies across a number of lenders, and one of them might suit your circumstances much better than another at a particular point in time. But yeah, definitely I would not recommend just keeping everything in one basket because different lenders have different opportunities available, and it's definitely worth having a look at what others can provide before you make a decision.
Yeah, cool. Okay. Sorry.
No, that's all right. So, and then, business finance, cash flow finance, lots of different options out there at the moment, and you can use your business to secure the debt depending on what type of business it is. A number of you would be doing this already, but if not, if you've got a rent roll, you've got a law practice, you've got all, pharmacy, all that sort of thing, you don't have to use
financial planners.
Absolutely. Number of industries where you don't have to use the family home or your investment properties or anything to back up the debt. If your business is strong and it's trading profitably and there's a real value there, you can often use that asset to fund against. So that's something to think about rather than having to tie in your property, and you can sometimes use your property for other opportunities.
And again, some banks do business funding better than others, don't they?
Definitely. Yeah. So depending on whether you just need a debt solution, or does your business need the full relationship bank with transactional banking solutions and all that sort of stuff. But some banks are better for particular industries than others. So you want to go to the one that's going to work best and understand your business best, because when it comes time to grow or when things change, you want a bank that's going to understand what's going on within your business, can talk the lingo, within the industry you work within.
Absolutely.
And, they support those industries as well. So, yeah, always good to look at the best funder for your particular circumstances. We'll move on to the next slide. So asset finance, chattel mortgages. So asset finance, looking at particular assets to use in your business. That finance is on a fixed rate, so you know up front what the cost is going to be and your repayments don't change throughout the term of that facility. The charge is taken over the specific asset. Obviously, these are good for cash flow because you're not having a big capital outlay up front. You're able to use the asset straight away and make regular repayments. You're able to take advantage of instant asset write-off incentives.
And that finishes 30 June 2023. So any assets that you buy that are less than $150,000, you can immediately write them off, but you've only got another 10 months or so to do that.
Okay, you don't think they'll extend?
Haven't heard anything, but
yeah.
We've got the budget coming up later on this year, so we'll see what Albanese does.
Yeah, okay, so it might be worth thinking about what your business needs from an asset perspective and getting that done while it's advantageous. And with asset finance, normally once you've set it, that's the term you should plan to have it in place for, because it can be expensive to pay out early and you often end up paying the whole amount anyway. So if you're looking at asset finance, plan to have it in place for the term you take it out. With chattel mortgages, so we use these for movable assets, so your cars, your trucks, your anything that moves, and repayment terms are often are between 1 and 7 years. Your borrowing costs are a bit lower here because the loan's secured against the actual asset. And then you've got your tax advantages.
Well, then you got the interest on those chattel mortgages that are tax deductible. You don't actually get, unlike a lease, you don't get to claim the tax deduction on the actual payment. You claim it on the interest component and you get depreciation deductions as well. Normally with a chattel mortgage, your tax deductibility of these assets is greater than a lease would be in the initial years of acquiring the asset. So what have you noticed in terms, because I've been talking to some car dealers and stuff, and they're saying that interest rates have gone up to 6s and 7s in terms of some of these asset purchases. Is that what you're hearing?
Yeah, absolutely. So they've gone up considerably over the last 4 or 5 months.
Because I think I heard stuff that clients were locking in car finance at 1.99.
Yes,
only 12 months ago.
That's right, and that is true. And those days are well and truly gone.
Wow.
So you might have the odd, rate out there with a 4 still in front of it, but generally, with the suite of lenders that we have, car finance starts with a 6.
Wow.
Yeah, so big difference.
So you're not
in
only
cash
paying
flow.
top dollar for the car because you can't get it.
You're also paying top
through the nose
funds
for
to
interest.
finance it. That's exactly right. So it's obviously this comes down to this is accounting world rather than it's the best way to fund an asset. Is it still through one of these types of facilities, or are you better off, I don't know, drawing money against your home loan, or just so that all comes down to your individual circumstances. These facilities are certainly out there, but yeah, they're costing a lot more than they were a year ago. Okay, next slide. Cash flow funding options. If you want to get some hands on some funds quickly and easily to grow your business or for a particular purpose in your business, you can get $150,000 unsecured, low doc, very quickly if that's the sort of finance you're after. You're going to pay for it. you know, it's unsecured debt, so it's not cheap. You're looking at around 15% to start off with. You can also get up to 500,000 secured by a caveat over a property rather than a mortgage. So
what interest rates would you be paying on that?
You're paying, look, again, you can get some of that starting at 15 as well, depending on which lender you need to go with. That can go up to sort of 21, 22%. So there's obviously only very limited times that you'd want to use this type of finance. But again, all these types of finance have their place, depending on what you're trying to do at the time. But they can be very good for growth if you need to quickly address some cash flow issues and achieve something you're looking to achieve in your business. Next slide. So private funding is one of a bit of a chat about, because from what I can see, private funding is becoming a more popular option.
It's absolutely huge. The number of people that are using private funding because traditional banks are not as flexible and taking too long to deal with, to deal with transaction is driving people into using private funding. So I'll let you continue. But
yeah, timing is a huge one. So if there is something that is time sensitive from a commercial perspective, usually the banks, it can take up to 8 weeks or longer sometimes to get an approval in place. And sometimes people just don't have that sort of time. Also, as Taz said, it can depend on how the banks are assessing the application and serviceability. And sometimes a client, they've done their numbers, they know they can afford this debt, but the bank is saying they can't. So they'll often turn to a private funder, which can be just a security lend in some cases. Others will have sort of low doc options where they'll see very limited financial information. With private funders, look, they're looking to make their money upfront or quickly because this is generally a short-term solution. So your upfront costs with private funders are normally 2 to 3% of the loan amount. Rates sort of from 8% for a first mortgage and 15% for a second mortgage. And with private funders, you're generally looking at maximum LVR of about 60%.
One thing that I'll also say too, and private fundings, I've seen a lot of it being used in development work and stuff like that, where banks put caveats and conditions over how they're going to deal with the particular loan, how they're going to give the money out. Private funding does away with a lot of that and gives people a lot more flexibility in how they're going to deal with their assets and their business. But you're right, I suppose the important thing if you're going to go down the private funding route is that, obviously these are tied up for private funders usually give you money for a certain period of time. So at the end of that term, you want to make sure that you're able to sort of go to a more traditional lender or something that's
yeah, absolutely. Yeah, your exit strategy is everything with private funding. So they need to understand very clearly how you're going to repay this loan, because loan terms are normally 1 to 3 years. So I'd say 1 to 2 years with most. Some of them you can find for 3 years, but they need to understand how you're going to repay this. And it doesn't have to be, anything crazy. It might just my main banker is going to refinance this in 12 months' time because I'll have done this, this, and this. But yeah, exit strategy is key. You have to be prepared to pay the upfront cost because, again, they're short-term loans. The private fund is not making a whole lot of money from having this in place for a long period of time. And again, more and more options becoming available in the market with this type of funding because there's a real need for it.
Look, I suppose you've got to be very careful about your private funders too and who you go to, because there's a lot of guys out there that are sharks. And there's guys out there, players like Latrobe that have been around for a long period of time, and other guys that you would do with Sharon too that have been there for a while that are secure and do have the funds to back themselves up.
Yeah, absolutely. I'm just going to quickly plug this. Sorry, people. I'm going to plug this laptop
More
in.
technical difficulties.
Does it happen?
All right, shall we go on to the next slide, please?
Okay, and I thought I'd just briefly touch on stamp duty versus property tax, given that's a recent, fairly topical item. So home buyers can now choose to pay stamp duty or a property tax. You know, in some ways it's great, reduce your upfront cost, but on the other hand, it'll add that another bill to your annual expenses. Your property tax is $400 plus 0.3% of the property value, paid yearly.
And that's the Valuer General's valuation. And in dealing with the Valuer General's valuation and land tax objections, it's almost impossible unless you take that to court.
So that value is what it is.
Yeah.
Look, I guess, you know, if you're looking at a $1 million property and you do the calculations, it's about 16 years before you'll pay the amount of property tax that you will in upfront stamp duty. So, you know, if you're not paying that stamp duty, you can put those funds towards a deposit and perhaps get into the property a lot sooner. This will probably be a game changer for first home buyers because they're often, you know, having to save for so many years to get into the market. So this could be a good thing there. But thing to keep in mind is once a property has converted to the property tax system, that's how it stays. So all future owners have to pay the tax instead of stamp duty. You know, whether people are a fan of it or not could, you know, have an impact on the number of buyers looking to buy your property down the track. So I think it's something to think about if you're buying a property for a 3 to 5 year period, as opposed to if you're buying a property to stay in for 20 years. Something to keep in mind.
Correct. And the value of this tax, this property tax, like I said, is going to be determined by the Valuer General, and you're not going to have much say in terms of what this thing is going to be worth and how much tax you will be paying going forward.
So as far as the formal slides and presentation, that is everything. I'm now happy to take any questions or have any discussion if anyone has anything they wanted to ask.
Can I ask a question, Sharon? I mean, given what's happening at the moment, are your clients coming back to you in a panic and sort of saying, look, we want to change our facilities, we want to fix, we want what else is out there? Are you getting that inquiry, or are people a bit more calm about the situation?
Yeah, look, I think initially there was a lot of inquiry. So a lot of inquiry about people looking to fix. Unfortunately, by that point, it was already too late because banks are building in to their fixed rates, you know, months in advance, depending on the data that they're getting. So initially a bit of panic. I think now that sort of people understand a little bit more about where things are at and where they might land, people have settled down a bit. But I have had a lot of people, a lot more people than normal, just wanting to have a look at things across the board and see, you know, if they're getting a good deal and do they want to, is it worth reviewing things and looking at other lenders.
In terms of a lot of people have got sitting on fixed rates at the moment and stuff like that are probably going to be coming off in the next 6 to 12 months. Do you reckon that there's going to be a bit of an impact or a bit of hurt felt in that period of time? And obviously that may push some people over and force them to sell property. Which will obviously have a detrimental effect to the market, depending on how many people come onto the market to sort of get rid of their properties.
Yeah, look, I think when you're getting a home loan rate of 189, 199, look, you get used to it, right? You get used to your repayments and you think that's normal and you sort of go and spend money elsewhere and then it's hard to wind that back. So if you're coming off that sort of a rate in 6 months' time and you're going to 4.74, there's going to be a significant change upwards of your repayments. So I do think that will have an impact in some pockets. It's, you know, depending on timing, some people may have timed it beautifully and just taken that rate just before all this started to happen. And possibly by the time their fixed rate expires, things will be back on the downward trend. So it's all about the timing, when you're locked in, when you come off. But yes, I do think it's going to have an impact.
I think also you touched on the Ukrainian thing and the Russian war and all that sort of stuff. I think we're probably going to be coming into a period of time where there's going to be a lot of political instability, with Russia, I suppose, cutting energy supplies to the rest of Europe, especially coming into winter. That may play a massive role in what happens economically. Obviously, depending on what China does with Taiwan as well, that may affect. That's going to put more pressure on supply chain issues that we sort of currently have. Obviously, that'll all serve to increase prices and increase inflation and all that sort of stuff, which will obviously have a bearing on interest rates. So whilst the RBA might be saying it might be a bit, in 6 to 12 months we might be coming back into some rate cuts. I think depending on what happens politically, that may not be the case. So,
yeah, it's a
very interesting times.
Interesting times and differing opinions at the moment. But certainly the cost of living, and that's something else that has to be taken into account when you're looking at your borrowing capacity, because the banks are always reviewing.
They changed their policies because, I mean, after the APRA, the review, they became a lot harder and a lot firmer on serviceability, living costs and stuff like that. Any more changes likely to happen that you've heard about? Or?
Not that I've heard about recently, but suffice to say that the living expenses that are used are fairly hefty. And even if you don't spend that sort of money every month and you can demonstrate that, they're still going to use that bottom line cost of living.
And credit card limits have a massive impact on.
Yeah, and it's funny, the number of times people will say to me, oh yeah, I've got this credit card, it's got a 30 grand limit, but I never use it. It's like, well, it doesn't matter. That's going to be taken into account, because you could go and draw the 30 grand down tomorrow and then you have to service that debt. And you're looking at a servicing cost of about 30% of the limit of the loan on an annual basis. So if you've got a 30 grand card, even if you don't use it, in servicing is taking up $10,000 of capacity.
Which is a fair bit.
So if you're looking at borrowing money, have a good look at your credit card limits. And the other thing I'd say, just, comprehensive credit reporting. So everything is so visible to lenders now, so visible. Every loan, credit card, lease facility that you have in place is on your credit report, and every month's repayment is recorded. So if you're late on just one of those, it's visible to the lender and can impact your credit score and can impact your ability to get a loan approved.
Does that include things like pay by the month insurance and stuff like that?
So that's not on your CCR report yet. So it's more loans, credit cards, lease facilities, all that sort of stuff.
Gotcha.
Yeah, not your pay by the month services. So just something to keep in mind.
Awesome. Any questions that people may have that they want to put in the chat for Sharon? No?
Must have covered it all.
Well, thank you very much. If there's nothing else left, I mean, Sharon, do you have any final comments that you'd like to make?
No, just thanks for the opportunity. I think keep on top of your finances. Like I said, it's worth having a look. You can save a lot of money, and make sure you're structured the right way, and maybe save some tax as well.
Yeah, absolutely.
It's don't be lazy with this sort of stuff, because it can make a big difference to your overall situation. So more than happy to have a chat if anyone wants to reach out.
And if you don't have Sharon's details, reach out to one of us in the office, and we'll certainly put you in touch with Sharon. She looks after a lot of our clients, and a lot of them are very happy with the work that she does. So thank you very much for taking the time to be a part of this. Thank you for joining us also. And I wish you all a good day and a great afternoon. Thank you very much. Thanks, Sharon.
Thank you.